So let's talk about our fearless forecast for the year 2021. Without further ado, we will turn to that since this is the first Sunday program of the new year. Last year, as we mentioned earlier in the program, we were within 3% of where the markets wound up. So 97%, that's not too bad. The year before, 2019, we were within 150 points of where the Dow wound up. So that's almost like 99.5% accuracy. So we're on a bit of a hot streak, which probably means that we're due to run cold for this current fearless forecast, but we're going to share it anyway, along with some of the things that influences our fearless forecast for the year 2021. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So be sure and check us out on things like iTunes, Spotify, and the like. Or if you want to see a video of the program, you can also subscribe to our YouTube channel at Nelson Financial Planning. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life. Isn't that something that you want to do, particularly in a new year? Maybe that's on your resolution list. We'll be talking about some resolutions for the year 2021 in our next segment, but certainly our team can help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind for the future. So before we get to our actual number in terms of our fearless forecast, we thought it always good as we engage in this sort of annual tongue-in-cheek forecast, because as we were talking about in the last program, forecasts are just forecasts. They are predictions of the future, and nobody can do this. This is just a fun exercise that we started 3 decades ago on this program. There are certainly some key things that we want to talk about as we look ahead to 2021 that we expect will be big drivers of what's going on in the economy and what's going on in the markets. And first and foremost of all, we would expect 2021 to be a comeback year, right? I mean, the shutdowns that happened during the course of 2020, the expectation is as the vaccine rolls out, then that you're going to have people being able to do some of the things that they were simply not able to do, particularly in the second half of the year as the world reopens from COVID. But beware the first half would be what we would say. This vaccine is sort of, as we described in a communication to our clients on Thursday, the last day of the year. It's tantalizingly close, but for many it's probably not close enough yet. And so as you see these rollouts and things like that sort of hit snags and less people getting it at this stage than what they sort of had originally predicted, then that's going to make for a volatile first half of the year. For the entire year, it's estimated that the U.S. economy probably going to grow about 3%, maybe a little bit more than that, following last year where overall it was about a 4% contraction. So certainly 2021, the year of the comeback, but watch out, it's not going to be a smooth one, that is for sure. Number two, interest rates. Low rates are here to stay. They are certainly going to be a big part of the story. But there's also a beware in that takeaway, because with the federal funds rate set to target at 0%, the reality is that there's so much liquidity in the overall economic system. There's so much cash. When you've got interest rates that low, there's a tendency to borrow money and then just to have that cash in the economic system. And if you think of it like the tides. I mean, injecting so much cash into the economic system, which is what the folks in Congress and the Federal Reserve did, and rightfully so, in order to offset the economic damage that came with the COVID lockdowns. But when you do that, it's almost like you're pushing the tide in. And when the tide comes in, everything rises, right? And the reality is that it really has done a tremendous job, if you will, at creating that rising tide. And you can look no further than sort of the recovery in the markets to see the impact of that. If you compare sort of the previous crises that have happened over the course of the past 20 odd years. And you go back to 2000, 2002, which is the Y2K, the tech bubble bursting. During the course of that decline, the subsequent recovery took exactly 1,872 days to recover, for the markets to recover to the prior pre-crisis highs. Okay, so 2000, 2002, the Y2K, the dot-com bubble, all of that happens. Markets go down. It took a pretty long time, 1,872 days, for the markets to recover to those pre-crisis levels. If you then fast forward to 2007, 2009, financial crisis, all of that, from that turn in March of 2009, March 9th of 2009, it took the markets a total of 1,426 days to recover back to those pre-crisis highs. In the year 2020, as a result of the pandemic, when the markets turned on March the 23rd, it took them no less than 128 days to recover the previous high pre-crisis. And stop and think about that, just how, 128 days versus these others, 1,400 days or 1,800 days. That's less than a tenth of the time for that recovery to occur. And so if you look at that and you kind of look at the prior history of crises and recoveries, and we know that, markets ultimately recover, but for them to recover this quickly, it's a testament to these low interest rates, this cash in the system. It also makes us wonder, and this is certainly a factor in our fearless forecast for 2021, is if the markets maybe have already priced in a lot of the recovery, a lot of the COVID recovery already. Because when you look at those numbers, it really does suggest that this market has recovered much, much faster than historical comparisons of similar crises. So that also sort of weighs on our outlook and our forecasts for the year 2021, is whether perhaps in 2020 the market sort of stole some of the recovery in terms of their performance that you would typically see in the year 2021. Similarly, the concept of this being a K-shaped recovery, right? Where you've got certain parts of the economy that are recovering and doing very well and others that are not. It's certainly kind of a winners and losers type of environment, if you will. And so there, I think the question is that you need to be careful about the indexes and owning the index. When we do our fearless forecast, for example, we talk about it in relation to the Dow, but the Dow is just 30 companies. It's just a small slice of the American economy, and those 30 companies don't typically change during the course of the year. If you look at the S&P 500, that's 500 companies, bigger cross-section, if you will, but also a cross-section that is a static cross-section. So we think that investors might be better off in more actively managed types of investments rather than just owning the indexes in terms of the performance, particularly in the year 2021, and to a certain extent for the year 2020 as well. The reality is that there's definitely going to be some winners and losers, not just in the particular sector, but also inside of different sectors. There are going to be companies that were able to adapt and continue on in light of the pandemic, and then others that are not. So we think that there's going to be a little bit of a split, more of a K recovery that also has impacts from an investing perspective, particularly versus index funds versus actively managed funds. And then, of course, 2021 is going to be the year of the release of the pent-up demand. One of my Christmas presents was an Instapot, and we actually used it the other day. And so how that thing works is it's like pressure cooking, and so when the timer is done, it's actually pretty neat how it all works. If you don't have one, it's like the hot item, I guess. Anyway, you then hit the valve that releases the steam, and the steam just, because it's high pressure cooking. So the reality is that I think 2021 is going to be a lot like that, particularly when you look at experiences that cannot be digitized, right? You can't digitize travel. You can't digitize going to a live entertainment. You can't digitize going to a sporting event, and you can't digitize going on a cruise ship. So the reality is that a lot of those experiences are going to come back. In places like China, for example, that are sort of a little bit ahead in terms of recovery from the pandemic, you're already seeing air travel only down about 0.5% versus where it was, sort of the year prior. Here in the U.S., it's still down about 62%. And then the other thing to really be thinking about from an investing perspective is don't forget sort of the non-U.S. side of things. The fearless forecast that we do is on the Dow, which is U.S. companies, but be sure to look outside of the U.S. in terms of investing opportunities, because we think particularly in places like Asia, Australia, where the reality is that they're a little bit more ahead of where we are in terms of the COVID recovery. You may very well see 2021 as a year where the non-U.S. markets ultimately perform at a much better rate than the U.S. market. So make sure from a portfolio perspective that you wind up having that mix of U.S. and non-U.S. I think many people have sort of been siphoning off the non-U.S. for a while because it hasn't been doing as well. We could very well see 2021 being more of a turn where those international markets actually do better than the U.S. market. So those key takeaways, 2021, comeback year for sure, certainly unleash of pent-up demand, continued lower rates, that is for sure, versus the risk, right? The risk that the market already has sort of anticipated the recovery. It's the fastest by far in terms of the recovery, if you think about those numbers and those statistics we were giving earlier. And then sort of 6 more months, I guess, before I think everybody or the majority of us wind up with the vaccine. So we think those risks are going to perhaps weigh heavily. We think 2020 has already sort of taken some of the performance of what you would have expected to see in 2021. Remember, the markets last year were up about 15-16%. That's a big number considering what was going on economically with the pandemic. So we're calling for a more muted number in the year 2021 because of what happened, the strength of 2020. Our conclusion is to look for about 5 to 6%, which, by the way, is still a lot better than what you can get in cash and bonds. So here it is, market down. I know many of you do, and then you remind us of it going forward, and that's fantastic. So here it is, fearless forecast. We expect the Dow at the end of 2021 to close at 32,250, somewhere between that 5-6%. I think that comes in at the math comes in at about 5.5. So mark it down, write it down. We'll see how accurate we are for this year, 2021. Year-end target on the Dow, 32,250. That's our number. We come back, we're going to talk about some of the resolutions that you may want to add into the mix for the year 2021 here on Dollars and Cents.